3 years after the historic referendum to take Britain out of the EU, Brexit Day is finally upon us. Except it isn't. Anyone expecting a do-or-die finale to this box set is left with yet another cliffhanger. But in spite of Brexit, the US-China trade war and any other political rumblings around the globe, markets have yet to grind to a halt. Far from it. Amid the noise, we ask today's cool heads to forget politics and tell us what should be making the headlines instead.
We will be leaving the EU.
America is winning again.
Do not waste this time.
Hello and welcome to Cool Heads. Today I'm joined by Romain Boscher, Global Chief Investment Officer for Equities, and Marty Dropkin, Global Head of Research for Fixed Income. Welcome to you both. Romain, if I can start with you first of all. I don't know if you can weigh geopolitics. There's been an awful lot of it around. But how much impact is it having on corporate earnings, if any?
This political background noise is here to stay, but we shouldn't pay too much attention to it. It's first of all impacting FX markets. When it's about equities, we should remain focused on earnings. And when a year ago we were fearing a late cycle story, in other words, a recession per se, now we are not even talking about an earnings recession. So we are doing pretty well.
Okay, well, let's have a look at some data that we've got here. This is the Fidelity forecast for earnings growth. Last year was remarkable. This year, pretty flat, and it looks like a bit of a recovery next year.
Precisely because last year we had a fiscal stimulus. This year we are somewhat facing a pause, but for next year we will still enjoy a fiscal stimulus once again.
Okay, well, Marty, we're well into third quarter earnings. Is the picture that you're seeing right now supporting that rosy view that your equities colleague is showing us?
It's a very similar view, and across equities and fixed income here we share the same underlying fundamental data. What we've seen heading into the third quarter is expectations were fairly weak. And so even companies that have kind of met or not really outshined their earnings performance, they're doing okay and they're performing reasonably well.
Okay, which sectors are you looking at in particular then?
There's been a divergence, and so when we focus on the industrials names in particular, those continue to be fairly weak. And we see some weakness on the auto side, we see some weakness in chemicals, and housing as well. There's been some downturns there. Okay,
but you talk about a divergence, and we've got a picture here that shows basically consumer confidence against manufacturing confidence. And you can see with the consumer confidence, first of all, this is taken from just before President Trump was elected, and it rocketed and has stayed pretty robust since then. But if I put the ISM manufacturing confidence against that, they mirrored each other for much of that time until the beginning of this year, and now we've seen a remarkable divergence. What does that divergence mean, Romain?
It means that for sure we have experienced an industrial recession, and it's a quite unprecedented moment because we have been experiencing an industrial recession without a recession per se. And it's possible because precisely the consumer, and not only the US consumer, but the consumer worldwide, is still enjoying the benefit of a monetary and fiscal stimulus.
Is the consumer strength, is that enough to sustain the US economy?
It is, because the consumer has never been that big, both in absolute and relative terms.
Where does that mean the opportunities lie then, Marty?
Yeah, so the divergence is an interesting theme, and we've seen it in the fixed income markets and companies with stronger balance sheets, which have actually continued to perform quite well, and we remain optimistic about, and those with weaker balance sheets, which have not performed that well, and spreads have diverged in that regard as well. I think if we're looking ahead to opportunities, in the credit markets in particular, emerging market corporates remain very interesting. Spreads offer still some value, and alongside Romain's comments about earnings growth, there seems to be a decent outlook for those.
So does this mean that the fears of a recession have been put to bed for now?
Yes, it's priced in. So at some point, you should consider a value recovery, a value theme recovery. Having said that, I would make a clear difference between cyclical names and financial names, because interest rates remaining extremely low is not that good for financial names.
Okay, well, thank you both very much indeed. That's it for this episode. Many thanks to today's Cool Heads, Romain Boscher and Marty Dropkin. And that's the last in this series of Cool Heads, but we'll be back again soon. For now, from the team here in London, goodbye.